Good afternoon, everybody, and welcome back to the Schwab YouTube coaching channel. What a difference a week or two makes, everybody. Up next is building a stock portfolio. Of course, I am your host, Kevin Horner. Thank you all for joining me today. I'm pleased to be joined by my friend and fellow Schwab coach, Connie Hill, in the chat. Connie's going to be available to get the comments and questions I'm unable to manage live and in the moment, but I'm going to keep an eye on things for you nonetheless, everybody. So please take a minute, say hey to Connie. Feel free to drop your comments and questions, though, into the chat for the duration of the next 45 minutes or so. That'll be about the time frame we'll take this class as we review the close of the market today and look toward what might be happening for us the rest of the week as we try to set the table a little bit. So, interesting market we've had over the last week plus here. Things have really bounced quite nicely for us. And what we're looking to do is establish some new long underlying equity positions as we do in this class. The name, of course, kind of gives you that insight that we are looking for stock positions, not option trades. So our process might differ than what some of you are familiar with. But the plan here is to put us into long side positions, equity shares, and try to maintain them for as long as possible. And that will be part of our discussion today as we evaluate some of these interesting areas that have bounced quite nicely. Doesn't mean we're going to be looking directly in there or willing to buy immediately in technology, for example, which has bounced back quite nicely. So we'll talk a little bit about the close of the market, look at our example portfolio, and establish a couple of new positions in the account, or look to do so in tomorrow's open of market. So with that, if you're not already doing so, briefly, please follow Connie and me on X, Connie Hill, CS, Kevin Horner, CS. We'd appreciate the follow there. We try to post for you throughout the week with notable charts and data points, things that can be helpful to all traders, we hope. All right, let's get to our disclosures and then we'll jump into the mix of things here. So please, as always, remember that our conversation is exclusively for your information and your education. We do not make any recommendations here, nor do we endorse any specific approach to trading. What we will bring to the table here is going to be technical analysis driven. And so what we mean by that is we'll incorporate and mention, bring to the table thoughts and concepts that traders may be employing on their own, but you should consider these just informational and educational for you. Choose which ones of these make sense, which ones of these fit your approach to trading. Make sure that you are developing a plan that is consistent and comfortable for you specifically. Additionally, just bear in mind that we work here in the thinkorswim desktop application, a paper money version of that, and that should let you know that not everything that we do in paper money is going to be available to you in paper money. So please know that, particularly as it relates to the scan details. I'll try and call those out when we come to those situations. It's also important to remember that with the use of the paper money platform, not all of your options trades are going to go similarly, because in a real world example, the moment you are short an option, you can be assigned even if you are not in the money, and you can be assigned early. However, within the paper money version of our thinkorswim desktop application, that will never happen to you. You will not be assigned early. You would only be assigned on expiration Friday at the conclusion of market. So keep that in mind if you are working around getting familiar with your process and in terms of trading options there in the paper money version. Okay, so we get started with a look at the S&P, and boy, it has been a fantastic move since we last spoke, because when we last spoke, we had seen that the S&P 500 had managed to have a pretty interesting hammer candle, and we finished the week last week, or I should say this big gap maneuver, really led to some continuation here, and that's all we have seen since we got that last Tuesday move. So we got the what I'm calling Taco Tuesday, because I don't know about you, but I absolutely went and had tacos for lunch last Tuesday. And what happened thereafter was a gap open that has been held the entirety of the time. Now, that gap level or that gap zone creates a bit of a vacuum for us. You know, at some point in the future, Yes, we could very well revisit this, but it's not to pay attention to in the near term. So let's talk about the levels that matter as it relates to the S&P. We've got a couple of key ones. You've got that moving average, right? The 50-day moving average we're above now could be providing us some support. And for a lot of traders, especially those that are playing in this sandbox just the last 5 days here, we can start talking about maybe the ledge we created with today's open and low. So this gap level can give traders an area against which to base their next point of support or potential for a pullback in the market. I'm drawing a line in around the 7,000 level. This is where we have previously traded to, but not on a closing basis. So today we are closed at 69.67, but our high close in here has actually been in the neighborhood of 69. I think it's 69.80. Let me see here. Close 69.69, 69.39, 69.76. And then here we had one at 69.40. So yeah, I still think we are pretty close to setting a new 52-week and all-time high close, which is going to be very interesting if we can accomplish it. What's even going to be more interesting for us might be if we opened in the neighborhood of 7,000 and to see what action comes immediately following that, right? So we do have always a possibility to expect a breakout, but we shouldn't trade on expectations. We should trade based on some kind of validation of that. So let's see exactly where we get through. Yeah, you're absolutely right, Cecil. On an intraday basis, we've been to that. Let's see here. You call it the 27th. I think you're right on an intraday high, but I don't know that we closed there. On the 7th, our close, yeah, the 27th, our close was 6,978, and then the next day 6,978 on the 28th as well. Those remain our highest close, even though we did absolutely get through it on intraday. So we're still looking for it, right? We want to see that close over 7,000 to kind of validate things here. Hasn't come just yet. So if nothing else, the risk now is towards the bulls, because unfortunately, even though we are feeling great about our really excellent move to the upside, which is now looking at about a 10% clip off of the lows we achieved at the last trading day of March there, the 30th, or excuse me, I guess it wasn't it was the last day of March, wasn't it? The last day of March was this huge candle. So the day prior, we've up basically 10% from there. And that's very fast, but understand why it's so fast. And so this is part of the discussion I think that we should always bring to the table, which is the reminder of the speed with which these rallies can occur when we get news-driven information. And we have to at least suggest that this gap maneuver was created by the news, right? The idea that the administration was ready to talk Turkey, so to speak, with regard to the Iran conflict, and they wanted to bring them back to the table. And since then, it's been headline after headline about just that. So we lifted that risk, and since it's just been straight upward, right? So now the risk is that we get into 7,000 and then that's the end of it, right? Because there's been resistance up here before. So we need to at least be prepared that we might get to 7,000 and may not clear 7,000. If we clear 7,000 as a resistance level, we can start to expect momentum continuing to the upside. Very important to keep a close eye on things. We'll talk about this tomorrow morning with Brent and me in Trader Talk. So if you're wanting to see how things shape up at the open, at least join us for that one at the opening bell. Okay, the NASDAQ slightly better here, 1.8%, same situation, rallying aggressively, huge gap, holding the 50-day here and challenging the prior highs. We've been up to that ledge twice previously. This could be a third time. We need to get a close over that 26,000 level on the NDX here, essentially. We're looking for continuation once more. But again, if we are trading based on risk versus reward, it's important to note that we are nearer resistance here. And what do we most often expect when we get to resistance? We should at least expect some kind of a pause or maybe a pullback, right? Doesn't mean it has to happen that way. If we can push through aggressively, what a wonderful development that would be. But technology has been leading. Semiconductors have been leading in this bounce. We've got semis trading at highs again. So there's certainly some interesting opportunities and developments here. But again, we have to make sure that it fits our comfort for the trade if that's what we want to be in. And we're gonna bring in some new some new ideas, example trades rather, for the example portfolio. And we may very well do that with technology. But one of the things we're going to talk about is how it might not be all of technology as it relates to putting on new positions, risk management, and so forth. So I'll talk about that as well. The Russell today. Russell made a good move, 1.3%. Again, you can see it all playing out similarly, right? When one key aspect of risk has been seemingly, and I do mean seemingly because we don't know anything, right? We don't know to any extent. Is the conflict completely over? We haven't not. There's no papers being signed. There's no official agreements. It's just a lot of positive headlines, right? Well, we've got that same gap situation playing out here, and the Russell moving to very close to new all-time highs. In fact, today's move in the Russell probably finishes about, let's see, the close here, 27.18, so about 13 points away from an all-time high close in the small caps as well. So we're getting consistency across the board. You're getting consistent moves in technology. Here's your semiconductors trading to new all-time highs, and then your transports showing new all-time highs. And the one thing that stands out to me on this one, everyone, is that there was a little something happening back here, middle of the month, as the transport started to bounce. We got a rally that was actually in play even before the rest of the market was rallying on the lower oil. So what you got was a group that was so in tune with the movement in oil that instead of showing additional weakness middle of the month of March, we got rallies, 7% rally off of that bottom into the final day of March, and then a complete and total continuation to new all-time highs. And so what you've seen here, the reason I'm bringing it up, a 20% short-term rally. You're looking here in 3 weeks, this thing rallied 20%. Well, there was a little bit of that heads up based on the move that was happening in advance. So there was some clear dollars being devoted to an important space in the market. And this space was tied so much to oil that one could have been looking at this saying maybe something underlying this move should be notable. And then we got the breakout, and it's just been straight up since. So transports very heavy on relationships to oil. So when you look inside this, you can evaluate this group further. You know, you might utilize your air groups. So here's your stocks in the air, your airlines. We've got the levels set there. Let's see how the trucks look. Okay, truckers giving you a gap level and a gap and hold, kind of a short-term cup and handle look here. And then what about our rail stocks? And then a rail stocks holding the channel, but the longer range channel in here, right? This channel's been in play for a long time. Well, then you got the gap move, hold of the 50-day. This has been a little bit more casual, a little bit more comfortable on the rail. So there's your broad look at everything. Everybody, this has been a pretty good bounce back, right? So let's just continue to manage our positions and make sure that we are taking advantage of what we can and not overdoing anything. So let's jump to our example portfolio and see what changes we need to make, and also address the trades we tried to make last. Last week, actually for the last few weeks, we've been trying to get ourselves into EW. Let's take a look at that EW. Here, we've placed orders that are buy orders. So we have a buy stop. Let me back this off. I'm going to shrink this down a little bit so you can see all my orders. All right. What we did here, we started speaking about it back on in late February or early March. We were hoping to get a breakout. And I wanted to bring this one up just as to point out, one, we're not in the position here, but two, the better thing here is the reason we're not in the position. We didn't get the breakout. This is a wonderful example of a stock that we were willing to trade if we got the breakout, but we didn't get a breakout. And so we have not put ourselves into a position. And since we didn't get the breakout, what has occurred? Well, the resistance up here stayed resistance at about 87. And since then, we've been beaten back to this ledge of potential support. So now the question could be, everybody, for EW, yes, we're below the major moving averages, all three of them, below the 50, below the 20, below the 200, but we're on the trend line. So maybe a trader feels confident establishing a position with a tight strategy for exit if we broke down from here. So we can do something with this. We might just cancel out our existing trade here to buy on a breakout. Let's go ahead and consider buying in here at support and then putting an exit strategy beneath us, because we wouldn't want to stick with this if we broke the uptrend here. So in fact, I'm going to color this green line, a green line instead of white, so we know that it's an uptrend, even though I should be able to figure that by the slope of things here. So we're going to look at the lows we've made. So basically 77, and we have to once again consider our average true range. So quickly, what we're going to do here is just change our order. Our average true range is $2.04. And right now we are a buyer if we broke out, but that trade is a ways away from happening, right? We're about 8 points off. And so entry here might be better from a risk reward standpoint for us. And if we are right, well, then we've got an opportunity maybe to rally into that former resistance up here. Extend my line. And see, we could actually be looking at a stock where we could get entrance near 78 and we could target 87 for our exit for a portion of it. So let's consider this with not a full position size, but about 3/4 of a position size. It's just rounding that off just because 100 shares makes sense. And so what we're going to do is look for entry at under, let's say 79 tomorrow. And then our exit strategy will take our lowest low recently, 77, and then we'll go beneath it by the amount of the average true range. So that'll put us with an exit stop order underneath at around 74.95, somewhere in that range. Okay. And that's going to give us a nice little bit of wiggle room and a proper risk versus reward. Even if we got in at 79, we would be risking about $3 or so. Yeah, about $3, maybe $3.25. And then our upside could be as much as $8 or more. And we, again, don't have to be a seller of everything at 87 up here. So let's remember that and let's build that into the trade. So for this new example trade, we are going to do a buy custom with OCO bracket. So one cancels other. Our first step is to put us into the trade at a price not to exceed 79. That means if it's lower than 79, terrific, we'll pay it and we'll get in at 78 and change or something like that. Great. That's good for us. Then our upside sell target is going to be 87. And we're going to make that good till canceled. We need that to be for the entirety of the trade. And we're also going to only sell half if it gets there. That's because that's a possible breakout level. And so if it breaks, we want to participate. So by selling half at 87, maybe it still runs. We'll have half available to us. Now, the key to this trade, once more, is that we make sure we have our stop order in and we use that exit at a level we're happy with. So again, 77 down to 75. And then we're going to reduce that by, well, I'm going to go to, let's go to the high school graduation year. 94 it is. All right, so good till canceled. So just to revisit, we are buying 100 at a price that's at least that's 79 or lower for us. If we get in, we're going to have a target exit for 50 of our 100 at 87, and we're going to have a stop order exit at 74.94, good till canceled. That's a trigger price. That means that there's no guarantee we are able to get in at that price when we sell, right? That's a market order to sell. That means our execution could be a lot lower, or it could be a little bit higher. It could even be a lot higher in theory, but we need to be aware of that. All right, so there we go. We've got an order set for 100 shares. And then just as a reminder, everybody, don't forget, I didn't load my scratch pad here, but I just want to remind you about our goals as it relates to risk versus reward. We like, that should not be 3-to-1 risk. It should be 1-to-3 risk versus reward. We like rewards that's 3x our risk. And then we also want to make sure that we don't risk more than $1,000 on any one trade. And we know we wouldn't do that here because if we got in at 79, even though we can't guarantee our exit price at 75.94, we know that that would be pretty close and or a good chance that that's going to be close to it. And our exit would be about $3 or $4 of loss. So that all fits into our tolerance. So, I'd be honest, everybody, didn't expect to do that with the EW given what we've seen, but I kind of like it given that we are far from the breakout, and now we've got an exit strategy that we hope we can carry for longer than a few weeks here. This is a decent shot at kind of continuing the uptrend, even though it's trading below the trending moving averages. And if not, if we get stopped out of it, so be it. We'll move on. Okay, back to the portfolio here. Okay, we're going to check in on Archer Daniels and Fastenal. So first one is ADM. We've been managing this trade with the rising 50-day moving average. We don't want to make any changes here. We did get into the resistance zone, but you can see we didn't get our exit on our target. So we've missed our target there, everybody, but that's okay. We're still maintaining our existing stop. And the reminder here is we don't reduce our stops, we only raise our stops. So here, no changes made to Archer Daniels at this moment. Our hope is that the trend line maintains and rallies back, but if not, what we don't want to do is make this stop order lower because that increases our risk. And then back to Fastenal. Let's see. So Fastenal, we've got a little bit of a loss here at the moment. And we've got a bracket on this, well, excuse me, not a bracket, but a stop on this one as well. And our stop here is at, these were the previous lows, and we did not get stopped out on this day. It was very close, but again, we're sticking with it. All right. Oh yeah, Kelly, you can absolutely do that. Thank you for your question. The question is if we wanted to add another target higher, could we just add in a secondary order to that? And the answer is yes. One thing you might want to do in that regard, though, is make sure you get to the trade on EW and you adjust the stop sale because well, excuse me, not the stop sale. You could add in a second layer, yes, without adjusting the stop sale. Excuse me, I forgot. We have 100. And so even if you use the bracket here, you can have a 50 share level at our initial target and then another 50 shares at a subsequent target above. Yes, you can do that. Hey, great. Looks like we've got a survey opportunity, everybody. Always love hearing from you. If you've got the 60 seconds to let me know what your thoughts are on this class in particular, some things you might like to see us bring to the table differently, or in addition to what we already cover for you, let us know in that regard. Click that link and you can get to that post class, everybody. Okay, so no adjustments on the fast, no adjustments on Archer Daniels. Let's see what's going on with our Halliburton trade. Halliburton today pulling back a little bit, does not get us stopped out just yet. So let's see what that looks like. All right, so here is HAL. We've got our exit above us. You can see we've got a bracket on this one, everybody, right here. Here's how it looks. So we got pretty close a couple of weeks ago, but we missed it. So we didn't get sold out, but we're just managing our trade along the way. Our 50-day today is at excuse me, 36.01, and our ATR is $1.40. So $1.40 beneath that is going to leave us at 34.61. And our current stop, let's see what we got here. All right, current stop is at 34.24. So let's go ahead and just elevate this to 34.61, which I will do by right clicking, cancel. Actually, you know what I'm going to do is I'm just going to lift it by pushing it. So I'm just going to click and drag this one, everyone. So 34.59, that's within 2 cents. And I'm always fine erring on the downside for those. So we're raising this stop up to 34.59. That'll keep us 1 ATR beneath the 50-day moving average. It doesn't mean it has to hold, of course. It does. It has the risk for us getting stopped out, but that's okay. If we get stopped out, then so be it. If we get stopped out on this one, the odds are in our favor that it stays profitable, even though we can't guarantee it. So Halliburton looking okay. And speaking of okay, let's look at One Oak, OKE, as our last existing position. And holy cow, what a stop level we set on One Oak, everybody. This worked out great for today, at least. Obviously, we don't know if that's going to maintain as we go to tomorrow, but the weakness in the energy space at the open led to a gap move on One Oak. And this is a prime example, yet again. Hey, for those of you who've been here since January, or maybe you've been coming to this class, for the last couple of weeks, few months, what have you, how many times have we seen this already? We've been working with 1 ATR beneath our preferred dynamic trend line. Which of those moving averages do we prefer when we build these trades? Well, we did this one using the 50-day moving average, even though when we started it last week, we were above the 20. We used the 50, and lo and behold, it worked out. The low of today did not get us taken out of our trade because we placed our exit 1 ATR beneath the 50-day moving average. Could we get stopped out as early as tomorrow? Absolutely. But at least to this point, it's worked. So let's go ahead. We're going to leave this position as is. No changes here. That stop holds. If we get this to rally, get back above the 20-day, then what's going to happen is our 50-day will continue to upslope, and we can then next week consider making an adjustment. And I should give you all a heads up, by the way, now that I realize it. I'm off to Boston, not tomorrow, Thursday, as it turns out. Thursday through Saturday, and actually into Sunday, we do have the upcoming Boston event. So if you're in the area and you maybe haven't registered, hey, that's a great one to check us out at. You can always go to schwab.com/events to see where we are, but we'll be out there, and I will actually be taking Monday and Tuesday of next week off as PTO. So with that in mind, I will have a fill-in for the Tuesday class here, and that's going to be my friend Barb Armstrong. So we won't review any new trades with me next week. However, 2 weeks out, we absolutely will. Now, with that in mind, we need some new example trades. So, had some ideas for you all, some example ideas based on our scan tool. And I thought we could look within the uptrending of all time frames, but I'm using technology today. Well, Kev, why tech? Well, tech's been pretty good, of course. Let's take a look at our sector indices, so we can see where leadership has been over the last month, the last 20 sessions already. We can see technology back to leading, 6%, communications, 6% nearly, and same with discretionary, nearly 6%. And then our laggers, staples, energy, healthcare, utilities. So these are groups that we've been leaning into of late. And I thought, hey, let's look where we might find new groups, new trends that could be working. Now, this is tricky because what's gone on with a lot of these, everybody, is that there is a rally underway, and you're going to find many positions trading at highs. And with those stocks trading at highs, the risk becomes greater. It doesn't mean they can't continue, but in terms of establishing a comfortable exit strategy, that becomes problematic. So, and here's what I'm talking about. I'm going to go ahead and just load up applied materials as an example. Applied materials is perfectly appropriate to call a bullish pattern, right? You've got a nice long range uptrend. If we're looking at the 50-day moving average, you can see that retreats to the 50-day have been our opportunities for participation. What has been standing out to me, gap level here, okay? And so we could a trader put a trade on based utilizing a risk factor tied to the gap ledge? Absolutely. Could a trader do the same thing tied to the 50-day moving average? Surely. But look at the 50-day. The 50-day today is 40 points away from our close. And all that means is that the trader has to assume a deeper amount of risk. And so if we look again at my comfort for trade losses on any individual position, oh, I could lose $1,000 and I'd be okay. Well, that's great, but that means I could probably only own a small number of shares if I were comfortable allowing the stock to drop 50 points in order to get stopped out. That's not going to be comfortable for a lot of traders. So many of you traders, you'd be looking at the gap zone long before looking at the 50-day moving average, just based on the amount of risk. Okay. So what stands out to me is to not consider necessarily something like applied materials, though I certainly can agree a trader could use the gap ledge and be just fine. Take a look at something like HPE, the Hewlett Packard Enterprise. And here's why. So let me zoom this out a little bit. And let's put our moving averages back in. And then what we see here is a slightly different trend with the 20-day moving average. Now, first of all, price action has recently broken this downtrend. Not only did it recently break it, but it broke higher. It came back and tested the 20-day moving average. In fact, let's go with just the 20-day. So all through here, it was kind of all over the map, but except for what's gone on since, oh, right around middle of March, right? And so with the middle of March move, the 20-day has been supportive. So maybe this is a scenario where a trader could say, I can justify exposing a new balance and move on if the 20-day is not held, right? Doesn't mean it's going to work, but this looks a little different than, say, a trade in the applied materials or even AMD, which is approaching an area of resistance. We can always make a trade work. That's true. The problem is, by always trying to make the trade work, we might be forcing things. One of the key things that I have learned over time is to try not to do that, not to force my trades. Work with the trades that really speak to you, right? And for many of us traders, doing those trades those are trades that happen at very clear levels of support and resistance, and you have comfort from the trade the moment you step into it. And again, comfort doesn't mean it's going to work out, but it might give you a bit more of a proper approach. So if nothing else, let's look at HPE. Let's go ahead and put on an example trade here. We're going to zoom back into just the last year, and we're going to use the 20-day. Let's add our average true range. Our average true range is $1.15, and our 20-day today is 23.81. All right. So we're looking at an exit around 22.66 for our stop order. And I'm going to need an entrance. Let's go with a limit that is $25, not to exceed 25. It gives us about a 50-cent cushion. We call that a padded limit. right? We put in, and again, this is because we have the trade for tomorrow's business, so we need to bear this in mind. So let's go ahead and do and we're not going to target on this one. Actually, let's back this off. Let's just see. So there's your weekly chart. Okay. So if we happen to make a move through that 26 or 27 area, yeah, then we're going to be seeing all-time highs, and we don't necessarily want to take that off. That will hopefully what that leaves us with is a trade we'll look at in 2 weeks. So let's do this with a stop exit only, no target. Given the amount of comfort we'll have on this trade with our relatively tight stop, we can go up to 200 shares without exceeding our comfort zone for risk. So we'll do a buy custom with stop for 200 shares. Make sure that we link those up. There we go. All right, 200 shares for tomorrow at a limit of 25 or better. And our exit, good till canceled, with a stop at 22.60. No, I said 66. We're going to go a few pennies beneath it. 22.63. So if we get in there exactly at 25, our risk is $2.37. Not to suggest that we can get exactly that, but on 200 shares, that would put us at around $560 in risk, even though we can't guarantee that for that stop order. So that again becomes a market order, but let's go with it nonetheless. All right, so there's an HPE trade for us for tomorrow's business as well. All right, yeah, we got that survey. Thank you for reposting that, Connie. Always helpful to have your feedback, everybody. Let us take a look at another area. Let's go to, let's peek in on financials here, everybody. Okay, so something's on afoot with the financials, it might seem. Here is the financials. We broke the 20-day with last week's gap up. Then we had some little bit of give back, but boy, that candle yesterday sure was instructive. Look at that. Filled the gap to the number, if I'm not mistaken. Where was our high in here? 839.13, 839.88, and yesterday's low was 838.78. So it came all the way down, tested the gap, held the gap, closed at a short-term high yesterday. You got some continuation today. So could the financials possibly be in play here? The answer is yes. Doesn't mean it's going to, and it doesn't mean that we have to see them get above the 200-day, but there could be something going on if we can get through it. There's also a band of horizontal resistance up there in the financials as well. So this in mind, let's take a look in the uptrending all time frames and financials, and let's just see if we can see anything of note in here. What I learned when I was initially doing this morning, or this afternoon, excuse me, that the insurers don't look all that excitable. Here is Aflac holding the 200, but not really long range trending, right? You look at this on a longer term, it still looks like consolidation for quite a while. And granted, it's not bad. Consolidation is good, often leads to the continuation of the existing trend. In this case, the trend with which we came into it, which is bullish, as you can see, right? If I was to draw something like this, look at that. Boy, that's almost beautifully clean now that I look at it over the longer range here, catching the lows all the way. Caught the low here, barely. Caught the low here. So maybe this is starting to look a little bit more intriguing. Allstate also in a bit of a consolidation. This kind of, as the visual, first thing I thought of when I looked at this was a rising wedge, which is not quite as bullish, but nonetheless, an improving look at things over the longer run. And yes, that's absolutely true, JV. You're on the ball. We are going to be hearing from banks as well. And I thought we should look at a few of these. I was going to pick on one. Look at JP Morgan. Now, what stands out here? A couple of things. Number one, we've got the broken down trend, right? Number two, we've got all three major moving averages beneath us. We love it. as a bull when all three of the moving averages are possibly providing support. And the nice thing here, okay, so we know, yeah, let's see here. JP's they reported ahead of the bell today. So you've got basically a hold of what has occurred here. This looks a little bit notable because if nothing else, once more, can we set our risk properly? The answer to that on this one is yes, particularly for those traders who want to use something like the 200-day moving average. This could work out quite well. What about Goldman? I saw that one come through as well, Vicky. Let's take a look. Okay, there you go. Goldman. Now, they've already reported. Goldman is interesting. Let's talk about why. Look at that. Great, successful horizontal support test right at the 50-day, and then a flip, a gorgeous reversal on this. So it opened weakly yesterday and finished strong. And then look at the volume behind it. Goodness gracious. So let's always apply that. Let's bring that volume in here. I like to use volume average. Let's see, AVG vol. There it is. So on mine, there it is, added that in, and I'm going to make sure that that's in the volume pane so that this way the line will horizontally move through the vertical volume bars. That tells us the volume on these days. So this candle is green because the stock finished above the open yesterday, but the candle below the volume bar is red because the stock finished below the prior day close. So technically it was a weak close versus the prior close. And so volume was significant there. And that's positive though, when you think about it, right? Because if nothing else, we have validated that horizontal and 50-day moving average as support. We could totally build a trade here, but we're already looking at 40 plus points, right? Because if we incorporate the average true range under the 50-day, then we are going to need to go well below 871. So I thought that the look at JP Morgan was interesting. That was relatively close for entry. Let's see if there's... Yeah, see, this is another one, Northern Trust, another gap level. But again, we have to think about where are we in relation to the trend. So, some of these aren't going to quite work out as well as we had hoped. Let's see, SYF. Ooh, there's one that's getting through it, getting through a 200-day and a moving average, a 200-day moving average, and then maybe lows here. You could utilize these lows and then an ATR beneath them to manage risk. That's a possibility. And again, another broken downtrend starting to improve. Let's see State Street here. That's at new highs. And again, it's not to suggest that new highs can't work, everybody. It's just that you find yourself buying at new highs too frequently. Suddenly we're giving up more of our move, and we don't like that necessarily. So I don't know. Let's see. PNC. Now there we go. Okay. Well, here, this one looks a little bit better. And the main reason here could have been JP Morgan for sure, but just look at the consistency of price action for the last 5 sessions here, everybody. And let's use the 50-day and 1 ATR. So let's go with PNC to get some financial exposure here. Let me add in my ATR. Say the 50-day today is 217.20. And the ATR is 480. Okay. So we are looking at an exit around 212.40. And the only thing beyond that, everyone, is just notice where that is in relation to the 20-day. We're really believing in the 50-day by putting it in here, right? Because by putting it in based on 1 ATR below the 50-day and our 20-day being below our possible stop level at 212.40, it does mean that if this kind of, came down to the 20-day to test, yeah, we'd get taken out. So the alternative here would be to give it more berth, right? Instead of 212.40, maybe the trader wants to go with an ATR below the 210 the 20-day moving average. That might be the way that a trader does it. But we'll do it here real briefly, real quick, with a buy. And we can't go quite that high because that is a substantial position size. So we're going to drop this down to 25 shares. Whoops, I didn't do buy custom as I intended. So sorry, everybody. We're going to do buy custom, stop, 25 shares. And our limit for tomorrow is in at 212 or better. And then our exit, no, excuse me, our limit is at 222 or better. There we go. And then our exit, 212.40, and that's a good till canceled stop. Remember, can't guarantee that price. We might even come a few pennies underneath that just to give us a little bit of something to work with. So there we go, everybody. Buying 25 with a price not to exceed 222 and a stop exit down at 212.33, a market order once triggered. There we go. All right, everyone. So just as a reminder, we are appreciative of any feedback you offer, everyone. Use that link in the chat. Thank you, Connie, for offering that up multiple times. And thanks to all of you for being here today. Always love having you on the segments, joining me, and certainly appreciate you and your feedback. Now, don't forget to follow Connie and me on X. And if you like today's discussion, hit that thumbs up button for me down below. I'll get some notes made and we'll get this reviewed into the archive very shortly for you. And if you're available tomorrow morning at market open, come right back to the channel. Bright and early, market open, 9:30 a.m. Eastern. I'll be on with Brent Morris for Trader Talk, and we'll set the table for the day. So with that, have a fantastic rest of your Tuesday, everybody. Thanks for being here. I look forward to catching up with you all again real soon.